Joining us now to help us understand this latest decision by the Fed is Gary Stern, former president and CEO of the Federal Reserve Bank of Minneapolis. Thanks so much for making time for us today, Gary.
Thank you. Good to be here.
So the Fed changed its statement rather than suggesting more hikes are needed or more firming was needed. It said that the committee will closely monitor incoming information and assess the implications for monetary policy. So more data dependent there. Do you interpret that as the potential for a pause?
Yes, I do. I think it's a clear signal of that. And it's justified, in my opinion, for several reasons. First of all, the Fed has done a lot. Interest rates have moved up significantly over the last 14 or so months. Secondly, inflation has gradually been diminishing in the United States, and I think it's reasonable to expect that that trend will continue. And the pieces are falling, so the pieces are falling into place for a pause. And of course, you know, the pause may in fact not be permanent. If the Fed has misjudged the situation and if inflation turns out to be more stubborn than the Fed expects, they can always resume rate increases going forward, because the Federal Reserve does not make what I would call once and for all decisions. The Fed is data dependent. They analyze all the available information as it becomes available, and they make their decisions based on the tenor of that information and how it affects their view of economic prospects and the economic outlook.
Yeah, the Reserve Bank of Australia is a good example of that. It paused for one meeting and then sort of unexpectedly raised rates again just earlier this week. So this is the potential for a pause from here from the Fed. Now, do you think that the Fed should pause here? I understand that you think that maybe it should keep going.
Well, my concern is that inflation is going to turn out to be more difficult to reduce to the 2% target than perhaps the Fed expects. And I don't see any great risk in at least one more rate increase, say at the June meeting. I think that would be appropriate. But I want to add that policymakers at the Federal Reserve and central banks are almost always faced with decisions like this. And what I mean by that is it's never going to be crystal clear when you should pause or for how long you should pause or if you should reverse course. You're going to have to make those decisions, and you always have to make those decisions with some significant uncertainty remaining. And policymakers know that, and they're used to that. And they'll give it their best call, but that doesn't mean that they're going to be infallible. They certainly aren't. None of us is. But on the other hand, a mistake of 1/4 of a percentage point, or even somewhat more, is not fatal either, at least not for an economy like that of the United States, because the U.S. economy is very flexible and very resilient, and it can absorb a variety of blows, not just from the Federal Reserve, but from other events developing domestically and internationally, and still do reasonably well.
Yeah, Powell was speaking about that resilience, particularly when it comes to the labor market, Gary, and he was suggesting that maybe we would see the labor market, cool down a bit, but not have to go, as extreme, not to see those, terrible job losses that might necessarily be felt in a recession. How do you see the labor market progressing from here?
Well, the first thing I would say about that issue is the labor market has been very strong for a sustained period of time now in the U.S. I don't personally have a complete explanation as to the source or the origins of that strength, but I do look at the numbers, and they've been quite positive. And I don't think that situation is going to turn on a dime. So I expect that the labor market will continue to provide a source of strength to the U.S. economy for some time going forward. And I think that is one of the hallmarks of the recent path of the economy is the ongoing health of the labor market. And as I said, I think that's likely to persist. The employment gains may turn out to be smaller going forward than they have been in the recent past, but we shouldn't get too excited about that because they've been very large in the recent past. So if employment gains turn out to be sustained, that provides a good deal of underlying strength to demand and spending in the economy, and does raise the probability that a recession can be avoided, even though the Fed has clearly tightened monetary conditions significantly.
Gary, I also wanted to get your thoughts on, there were so many questions about the banking sector in the U.S. Thrown at Powell there because of the turmoil really that we've seen unfold with the failure of several banks in that country. You co-authored a book back in 2004 called Too Big to Fail, The Hazards of Bank Bailout. So you're pretty plugged into this sector. How do you view the handling of those failures?
Well, I think the resolution of those failures, once you're in the midst of a crisis or at least a very challenging situation like that, you typically don't find yourself with very good options. And so I think the handling of the crisis has, in many ways, not in all ways, has in many ways been appropriate. I think the real problem is that the whole situation has been is an embarrassment both for the bank management and directors involved and for the bank supervisors, including the Federal Reserve involved. This was an entirely avoidable situation if people had done their jobs, but they didn't. And the onus of that, responsibility for that, is on the supervisors and on the bank directors and managers. And there's no way of sugarcoating it. And people, that's where the responsibility lies. That's the problem. And it's not, as we have said, it's not easy to fix. I did co-author a book on that back in 2004. I still think our suggestions were sound then, but I think now we're in a different environment, and it's going to take different action.
So what happens, Gary, do you think, if there are more failures, among these U.S. regional banks? Because we were speaking to one of your fellow Fed chiefs earlier today, former Kansas City Fed President Thomas Honig, and he said if more banks started to fail, then that was going to put more pressure on the Fed to pause or even reverse course. What's your sort of assessment of the pressure that it could put on the Fed from here?
Well, I think I would agree with former President Honig on the direction, but I think he's overestimated the impact. First of all, principally because the U.S. banking system is so large and diverse, and there aren't that many banks that look like Silicon Valley or First Republic. A lot of smaller community banks are in a whole different lines of business. The very largest banks are much better capitalized and stronger than they were prior to the previous financial crisis. So, if there's another accident or two along the way, I personally don't think that has major implications for the financial sector nor for the economy. I just don't see it. In fact, I'm not persuaded that the banks that have failed to this point, had depositors lost some money, not their entire balances, but had they lost some money, I'm not persuaded that would have had a profound impact on financial conditions or the economy either. But as I said earlier, once you're in the middle of one of these very challenging situations, you typically don't have good options.
Gary.